So it's 2026, and let's be honest, the market is just confusing, right? One day tech is soaring, the next, the whole thing gets dragged down by global jitters. So in all this chaos, where do you even look for some stability? Well, we think the answer might be hiding in plain sight, at a company that's basically become a fortress in this storm, Costco. All right, just to see what we're talking about, look at this. It's like the market has a total split personality. Take April 24th. On one side, you've got a tech giant like Intel crushing it, and the NASDAQ takes off. But on the other side, you have the Dow, the broader economy, getting spooked by things like oil prices and global tensions. It's this constant push and pull that has so many investors feeling uncertain. But, in the middle of all this chaos, there's one company that's just completely ignoring the drama. I mean, look at this chart. The S&P 500 is down 3% for the year. Meanwhile, Costco is up almost 19%. That's not just beating the market, that's lapping it. So you have to ask, what is going on here?
And that's really the big question we're digging into. In a world where every investor is scrambling for some safety, why are they all running to a big box store? What makes Costco this impenetrable fortress everyone is talking about?
Well, it really boils down to something pretty simple. When the market gets shaky, you don't want to bet on a long shot. You want a sure thing. You want predictable profits and customers who are so loyal they'll show up no matter what. We call these defensive stocks. And right now, Costco is basically the poster child. All right, so let's pop the hood and see what makes this engine run so smoothly. It really comes down to three key things, three pillars of power that all feed into each other and create this incredible strength. Pillar number one is the membership model, and this number, wow, a 92.1% renewal rate. That is just insane. Think about that. That means once you become a Costco member, you basically never leave. This isn't just a store, it's a subscription business with a super high margin recurring revenue stream. And for investors, that kind of predictability is pure gold. Then there's Kirkland, and let's be clear, this is not your average generic store brand. This thing is a monster brand in its own right. We're talking 90 times $1 billion in sales. To put that in perspective, that's bigger than giants like Nike or Starbucks. And in a world where everyone's feeling the pinch from inflation, having a high-quality, low-cost option, well, that's a massive, massive advantage. And hey, if you've got this image of Costco as just a big, dusty warehouse, you need to update your thinking. Their digital sales are exploding, growing over 22% year over year. They're grabbing that younger, online first generation, proving they're not some retail dinosaur. That's absolutely huge for their future.
So how do all these pieces fit together? It's a classic concept called the flywheel effect. It's actually pretty simple, but incredibly powerful. The low prices bring in more members, right? Well, more members means Costco can buy stuff in absolutely massive quantities, giving them insane leverage to negotiate even lower prices. And what do those lower prices do? They attract even more members. It's this beautiful self-reinforcing cycle that just keeps spinning faster and faster.
Okay, so it's a fantastic company. We've established that. But, and this is a huge but, a great company isn't always a great stock if you pay too much for it. And that brings us to the billion-dollar question everyone is debating right now.
So here it is, the question you have to ask yourself. The stock is over $1,000 a share. Is that price tag justified for a truly premium, one-of-a-kind asset? Or has it just gotten way, way ahead of itself and entered dangerously overpriced territory?
And you've got two very passionate camps here. The bulls, the optimists, they say, look, you're thinking about it all wrong. It's not a grocery store. It's a subscription club with insane loyalty, and that kind of business deserves to be expensive. But then the bears, the skeptics, they come back with some cold, hard math. They point to metrics like a PEG ratio near 5 and say their cash flow models show the stock is almost 30% overvalued, period. And to really hammer home the bear case, look at its PE ratio. This basically tells you how much you're paying for every dollar of the company's earnings. Costco's is almost 47. The average for a big company in the S&P 500? That's 25. So you are paying nearly double the price for Costco's earnings compared to the rest of the market. That's a steep, steep premium. So what's the big danger of paying that much? It's this idea called multiple compression. Imagine this. The company keeps doing great. Sales are up, profits are up, everything is humming along. But the stock price goes nowhere. Or even worse, it drops. How is that possible? It happens when the market just decides, you know what, I'm not willing to pay that super high premium anymore. The value multiple shrinks, and even if you own a great company, you can lose money. All right, so with all that in mind, amazing business, scary high price, what's an investor supposed to do? let's get practical and look at the game plan some analysts are suggesting right now. So the advice here isn't to just jump in and buy at any price. It's about being strategic. They're pointing to a buy zone around the $990 to $1,005 mark. Basically, wait for a little bit of a pullback. In the short term, they think it could hit around $1,070. Long term, maybe way higher. But, and this is key, they're also saying you need a safety net, a stop loss below $965, just in case the whole trend breaks down. So, to sum it up, the strategy comes down to 4 key actions. 1. Don't go all in. Think of it as maybe a 10 to 15% slice of your portfolio, a defensive anchor. 2. That dividend just went up. Take that new $1.47 per quarter and just reinvest it automatically. Let it compound. 3. All eyes on May 28th. That's the next earnings report, a huge potential catalyst. And 4. Keep a close watch on their profit margins. You want to see if shipping costs are starting to take a bite. All right, so pull out your calendars. May 1st is the key date for that new dividend. May 28th is earnings D-Day. And just generally, keep an eye on oil prices. That's a huge external factor that can directly hit their bottom line, so you'll want to watch it. You know, there's a quote that I think just perfectly captures how people see this company right now. It says, Costco isn't just a supermarket. In this volatile sea, it's a sturdy lifeboat for the investor. And that's really it, isn't it? It's seen as this rare place of both safety and growth, which is so hard to find. And so that leaves us with one last question to chew on. We know Costco is a fortress built to thrive in a storm, no doubt about it. But what happens when the sky's clear and the seas are calm? In a roaring bull market, will people still be willing to pay lifeboat prices for what is essentially a cruise ship? That is the billion-dollar question you have to answer for yourself.